Hello and welcome. On this lecture video, we are on page 112 of your course pack. And in this lecture video, we're going to do this problem, okay? So our computer company, Ceres Computer Sales, uses perpetual inventory accounting systems. Remember what that means is that means that each time they make a sale, they'll debit cost goods sold and credit merchandise inventory. They had the following transactions during December. Okay, so what we have to do is prepare the journal entries to record each of these transactions, okay? So what I want you to do is I want you to do December 1st, December 3rd, and December 4th. I want you to do those first three, pause the lecture video, and then come back and we'll check it, okay? Thanks. Okay, hello and welcome back. So you can see on December 1st, the first one, it says sold merchandise and credit for terms 5,000, terms 310, net 30. The items sold at a cost of $3,500. So the journal entry, remember when we make a sale, we have to have two journal entries. First one to make a sale, the second one to record the cost of goods sold. So we debit accounts receivable because it says it's on credit for 5,000, credit sales 5,000. And then we debit cost of goods sold for 3,500 for the cost basis and credit merchandise inventory for 3,500. Okay? On December 3rd, it says purchase merchandise for cash 720. That is debit merchandise inventory and credit cash. On December 4th, it says purchase merchandise on credit for 2,600, terms 1% within 20 days, net 30. That's what this is saying. You get a 1% purchase discount you pay within 20 days. Otherwise, the full amount is due within 30 days. So this one, we're buying merchandise inventory on credit, not for cash. So it's debit merchandise inventory and credit accounts payable. Okay? So let me come back over here. I'm going to pause the lecture video for a second. I'll be right back. Okay, so let's look at the fifth. Issued a credit memorandum for $300 to a customer who returned merchandise purchase November 29th. The return items had a cost of $210. Okay, so what's going on here? Is this a purchase return, purchase allowance? Is this a sales return or sales allowance? Because you can see there's merchandise being returned. Well, this is a sales return. Okay, how do I know that? Well, let's read. For $300 to a customer, so that's telling me it's the sales who return the merchandise to us. Now, let's look at this first part. It said issued a credit memorandum. So remember in a prior lecture video when we were talking about accounting for purchasing merchandise inventory, we said that the purchaser will send a debit memorandum to the seller when they return merchandise, or they want a purchase allowance. And so the debit memorandum says the buyer is going to debit the accounts payable to the seller. That's why it's a debit memorandum. The seller would then send a credit memorandum to the buyer. I'm going to repeat that again. The seller will send a credit memorandum to the buyer. Why a credit memorandum? Because the seller is going to credit their accounts receivable. So in this situation, the seller sends a credit memorandum for $300 to the customer, the buyer. The buyer would then send a debit memorandum to the seller. But in this case, we're the seller, okay? So we have to think about that journal entry. So I'll come over here and do this one on 12/5. Remember, there's two journal entries when we have a sales return. The first one is, come in here and we debit sales returns and allowances for the purchase price. Okay, so it's for our $300, and then we credit their accounts receivable, hence the credit memorandum for $300. That's the first journal entry. The second journal entry is the buyer has returned the merchandise to us. So now our merchandise inventory goes up, and that's based on the cost basis. So we debit merchandise inventory for our 210, and then we credit our cost of goods sold for 210. Okay? All right. So that's December 5th. We've already gone over we've gone over through December 5th. Let me take a second over here and just comment on the 15th, and then I'm going to turn you loose to do the rest of these, okay? So it says on the 15th, it received a credit memorandum for the return of faulty merchandise purchased on December 15th, okay? So in this case, we received a credit memorandum for the seller, and that's for faulty merchandise that we purchased on December 4th. So this, right, we would receive the credit memorandum, and then we would send them the debit memorandum. See, on the 5th, we issued the credit memorandum. Here, we're receiving the credit memorandum. So we are receiving the credit memorandum and issuing the debit memorandum. Up here, we issued a credit memorandum and we received a debit memorandum. Okay, so this one, really, the equivalent of this is saying we issued a debit memorandum. We received the credit memorandum, so this is a purchase return. Okay, that's what this is. It's a purchase return. Okay. So with that, why don't you go ahead and finish the 11th, 15th, 18th, 23rd, 24th, and then 31st, and then we'll come back and check it. Okay. Thanks. Okay, so let's look at the 11th here. It says received payment for merchandise sold on December 1st. Well, you have to look up here and say, okay, that's 10 days. So 10 days from the 1st is the 11th. So we're receiving payment, right? So, and they're paying us within the discount period. So we have a purchase discount scenario here on the 11th, and it's 3%. So we come over here on the 11th. We're going to get cash. We debit cash for 97% of that $5,000. Okay, and then we debit our sales discount for $150, and then we credit our accounts receivable for $5,000. It's because it's within the discount period, and it's a 3% discount. So we get 97% of that receivable in cash. Okay, so on the 15th, we received the credit memorandum for the return of faulty merchandise purchased. So this is a purchase return allowance. Okay, so what that means, we are going to come over here and we're going to debit our accounts payable and we're going to credit our merchandise inventory. Okay, so moving forward to the 18th, it says paid the freight charges for $200 for merchandise that was ordered last month of $200 right over there. It's FOB shipping, which means that we have to pay for it. Sorry, let me move that up. That means that we have to pay for it. So we debit merchandise inventory. The cost basis goes up. Because remember, the cost basis of merchandise inventory is what we paid for it plus any normal and reasonable expenditures to get it ready for sale. That would include shipping charges. If it's FOB shipping means the buyer pays. We're the purchaser, we're the buyer, so we have to pay for it. We pay for it with cash. Okay? It says on the 23rd, paid for the merchandise purchase on December 4th, okay, less the portion that was returned, okay? So we have to look over here, and we said, remember, we had our $2,600, okay, purchased merchandise, but then we returned $600 right over here. That means our outstanding accounts payable is only $2,000, okay? And then we have to look back over here. That was from December 1st, so we have to look at the credit terms. Right, so it says 1% within 20 days, and you can see that was on the 4th. 20 days later would be the 24th, and so we're talking about the 23rd. So we are within the discount period, which means we can take that 1% discount, and that's that credit to merchandise inventory. That's our purchase discount for 1%, and we have to pay 99% of that in cash. We credit cash for 99% of the $2,000. All right, so let's look at the 24th. Sold merchandise on credit for $7,000, terms 210, net 30. So this is just a debit to accounts receivable for $7,000, credit sales $7,000, and then debit cost of goods sold, 4,900, credit merchandise inventory, 4,900 right over here. And then on the 31st, we received payment for the merchandise sold on the 24th. And so you can see 10 days, that's the credit period. I'm sorry, the discount period is 10 days. And our customer paid us within the discount, which means we have to give them a 2% discount. So that's our sales discount. So we debit cash for 98% of that $7,000, their bill. And then we have our sales discount, which is that 2%. And then we credit accounts receivable for that 7% right there. Okay? All right, I hope you got all those right. I would really encourage you to make sure that you understand this problem really well, because it does a great job of going over all the transactions that we talked about. Okay, so make sure you understand this problem really well. Okay, and let me know if you have any questions. All right, so I'm going to end this lecture video now, and then the final lecture video for the chapter will be talking about closing journal entries. Okay, thanks.